Multifamily Millionaire: How to Invest in Real Estate and Strike It Rich. Real estate investing is one of the most lucrative and potentially profitable investments you can make. For many investors, multifamily properties are a great way to start building wealth, especially if you're looking to strike it rich. In this video, we'll explore the many benefits of multifamily real estate investing and provide you with the tools and strategies you need to become a multifamily millionaire. Before we get started, it would really help us out if you hit the like button, subscribe to the channel if you haven't already, and click on the notification bell to make sure you don't miss out on our next videos. Ready? Let's begin. One of the biggest benefits of investing in multifamily properties is the ability to generate passive income. Unlike stocks or bonds, which require you to constantly monitor your investments and make decisions about when to buy or sell, multifamily properties can generate income for you passively, with relatively little effort on your part. This income can be in the form of rent from tenants, which can provide you with a steady stream of cash flow. Another benefit of multifamily real estate investing is that it's relatively low risk. Unlike other types of investments, such as stocks or commodities, real estate values tend to increase over time, providing you with a hedge against inflation. Additionally, multifamily properties are often in high demand, so it's less likely that you'll have trouble finding tenants to fill your units. Another advantage of multifamily real estate investing is the economies of scale. When you own a large multifamily property, you can spread out the costs of maintenance, insurance, and management expenses over several units, reducing your overall costs. This allows you to generate more income from rent, which can help you build wealth more quickly. You can also benefit from economies of scale when it comes to marketing and advertising, as you can target multiple units at once, making it easier to fill vacancies and increase occupancy rates. This type of asset also provides you with more control over your investment. With a single-family home, you're relying on one tenant to pay the rent, whereas with a multifamily property, you have several tenants paying rent, which can help to reduce the risk of lost income if one tenant stops paying. Furthermore, multifamily properties offer a great deal of flexibility. You can choose to rent out each unit individually, or you can rent the entire building as a single unit. This gives you the freedom to choose the type of tenants you want and to control the rent you charge. This can help you maximize your profits and minimize your risk. When it comes to choosing a property, location is key. You want to find a property that is in a high-demand area where there is a strong need for rental housing. This will help ensure that your property will be easy to rent. Properties in desirable areas with good school districts, proximity to shopping and public transportation, and other amenities tend to command higher prices. Similarly, properties in areas with high crime rates or a declining economy are typically less valuable and may take longer to rent and eventually sell if you needed to sell in the future for any reason. Finding a great property to buy can involve looking at off-market properties, local MLS listings, auction websites, and real estate investment clubs. You should also consider working with a real estate agent or wholesaler who specializes in multifamily properties, as they can help you find the right investment opportunity and negotiate the best deal. To accurately determine the potential selling price of a property, it's important to do your research on the local real estate market. You can start by looking at similar properties in the area that have recently sold and taking note of their prices, amenities, and location. You should also consider the current state of the real estate market, as well as any recent economic developments that could impact the value of the property. You should have a clear understanding of your potential return on investment, what your cap rate will be, and how the value of the property could go up with your renovations and higher rental rates. This forced appreciation is another great wealth builder, especially if you later refinance the property and put part of that new equity into a new deal. However, you should also be mindful of over-renovating the property, as this could increase your cost and reduce your profits. Instead, focus on making targeted, cost-effective improvements that will add value to the property without breaking the bank. There are several strategies that you can use to add value to your multifamily property. Upgrading the property is one of the easiest ways to add value, simply by making upgrades and improvements. This can include anything from minor cosmetic improvements such as painting and flooring to more substantial upgrades such as updating the kitchen and bathrooms, adding new appliances, and upgrading the heating and cooling systems. Enhancing amenities is another way to add value to your property. This can include adding a fitness center, a swimming pool, a community room, or a playground for children. By implementing energy-efficient measures, you'll be helping the environment while also increasing the value of your property. This can include adding insulation, replacing old windows, and installing energy-efficient appliances and lighting. Providing additional services such as laundry facilities, on-site parking, and maintenance services can also help to increase the value of your multifamily property. Repositioning the property, such as converting it into a high-end luxury apartment complex, can be a great way to add value and increase your returns on investment. It's important to keep in mind that while adding value to your multifamily property can be a great way to increase your returns on investment, it's important to weigh the costs and benefits before making any changes. Once you've done all your research and chosen a property, the next step is to perform due diligence. This means thoroughly researching the property, the local real estate market, and the neighborhood to make sure that you're making a wise investment. You'll want to look at factors like the current rent prices, the number of units available, the cost of repairs and renovations, and the potential for future appreciation. It's important to be disciplined and focused in your approach to analyzing each deal. This means avoiding common mistakes, such as over-leveraging your investments or neglecting the importance of proper due diligence. It also means having a clear understanding of your goals, risks, and opportunities, and making decisions that align with your long-term financial strategy. When you've completed your due diligence and you're ready to move forward, it's time to get financing. You'll want to work with a lender who has experience working with real estate investors and who can help you find the best financing options for your investment. You can consider getting a traditional loan through a bank if you qualify and if the numbers make sense. There are other creative financing options you might want to consider, especially for those who are just starting out. The traditional financing methods, such as taking out a mortgage or obtaining a loan, may not always be available or may not provide enough funding to make the investment profitable. In these cases, creative financing options can provide a much-needed alternative. One of the most common forms of creative financing is seller financing. With this option, the seller provides the financing for the purchase of the property, sometimes requiring a down payment and regular payments over time. This can be a great option for investors who have limited access to traditional financing, as it eliminates the need for a mortgage or a loan. Some sellers have a mortgage that they are willing to let the buyer keep paying, which is another strategy called subject to. In times of increasing interest rates, it can be a real treat to buy a property and be paying a loan with a much lower interest rate. In these cases, the buyer doesn't need to use their credit since the loan stays in the previous owner's name. There are certain risks and details you must be aware of, such as how to work with a due on sale clause and other issues that may come up. So make sure you do your homework and talk to other professionals that have done this before and can help you do it right from the start. Another creative financing option is joint ventures. This involves partnering with another investor to purchase and renovate a property. Joint ventures can provide investors with access to additional capital, as well as shared knowledge of the market and industry. They can also help to reduce the risk of investment by spreading it across multiple parties. Partnerships with other real estate professionals, such as contractors and architects, can also be a great way to finance multifamily properties. By working with these professionals, investors can obtain the necessary expertise and resources to make their investments a success. This type of financing can also help to reduce the costs associated with the purchase and renovations of the property, as the professionals involved may be willing to provide their services at a lower cost in exchange for a share of the profits. It's also important to consider the benefits of private lending. With this option, investors can secure funding from private lenders, such as an individual or private equity firms. Private lending can provide investors with access to larger amounts of capital and can also offer more flexible terms and conditions than traditional financing options. Creative financing is a great tool for real estate investors, and it's important to explore all of the options available to find the one that works best for you. Whether you choose seller financing, joint ventures, partnerships, or private lending, having access to creative financing options can help you lock in that deal and close on the purchase. Finally, once you've acquired the property, it's time to start generating income. You'll want to carefully manage your property, making sure that it is well maintained, that you're attracting high-quality tenants, and that you're maximizing your rental income. You can do this by setting competitive rent prices, investing in property improvements, and providing excellent customer service to your tenants. Managing your property can also be time-consuming, so it's important to have a clear understanding of the responsibilities involved and to have a plan in place for managing it effectively. This can involve hiring a property management company, or it may involve managing the property yourself with the help of a team of professionals, such as contractors and accountants. To effectively market the property to get tenants, it's important to have good quality photos and descriptions of the property. You should also take advantage of online real estate listing websites, as well as traditional methods such as newspapers and real estate magazines. Additionally, you may want to host open houses or property viewings to give potential tenants a chance to see the property in person. Working with a good real estate agent to help you in this process can be a good idea, especially if you've never done this yourself. They will provide all the necessary contracts, verify potential tenants, and do all the marketing and showings for the property. By purchasing a multifamily property and holding onto it for several years, you can enjoy the benefits of long-term appreciation and an increasing income stream from rent. This means that you can benefit from the growth in the value of the property over time, as well as the income generated by the tenants. As the property increases in value and your income stream grows, you can reinvest the profits into other properties, helping you to build a diversified real estate portfolio that will provide you with a steady stream of passive income for years to come. Make sure to talk to your accountant or CPA about depreciation. This is a very powerful tool that real estate investors use in order to legally pay less in taxes every year. Ever wonder why you hear about the super rich not paying taxes? Well, now you know one of the vehicles they use in order to keep more money in their pockets. Becoming a multifamily millionaire takes time, patience, and a commitment to learning and growing as an investor. However, with the right tools, strategies, and mindset, it's possible to turn your multifamily investments into a successful and lucrative portfolio. One of the keys to success in real estate investing is to be persistent and to never give up. This means continuing to learn, grow, and make informed decisions, even in the face of challenges and obstacles. It's also important to have a long-term perspective and to be willing to take calculated risks to achieve your financial goals. In conclusion, multifamily real estate investing can be a highly lucrative and rewarding investment strategy, but it requires a certain level of knowledge and experience to be successful. Investing in multifamily properties can provide a great deal of stability even in uncertain times. People will always need a place to live, and the demand for rental properties is generally high regardless of the state of the economy. This makes multifamily properties a great choice for long-term investments that can provide you with a steady stream of income for years to come. Check out this next video to add more value to your time invested growing your knowledge. Thanks for watching, and we'll see you in the next video.